Imagine this for a moment. You travel to another country with just $100 in your pocket. Suddenly, everything feels cheap. Food costs less. Transportation is affordable. You can buy things you would normally think twice about back home. For a brief moment, you feel rich. Now flip the situation. Someone from that country visits yours with their own $100. They struggle. Prices feel high. Their money disappears quickly. Same number. Same effort to earn it. Completely different results. So the question is simple, but powerful. Why does money feel strong in some countries and weak in others? At first glance, it doesn't make sense. Money is just paper, or a number on a screen. There is nothing physically special about one currency compared to another. No currency is made of gold anymore. No currency has magic inside it. Yet somehow, one unit of money can buy a full meal in one country, and barely a snack in another. To understand why, we need to step away from numbers for a moment and look at what money actually represents. Money is not value itself. Money is a claim on value. When you hold money, what you really hold is a promise. A promise that you can exchange that money for goods and services produced by other people. So the real question becomes, how much value does a country produce? And how much does the world trust that value? This is where currencies begin to differ. Every currency is tied to the economy behind it. The people, the businesses, the factories, the farms, the technology, the skills. When a country produces a lot of things that the world wants, its currency becomes more valuable, not because the paper is better, but because the promise behind it is stronger. Think of it like this. If you had a gift card, but the store was empty, the gift card would be useless. But if the store was full of high-quality products, that same gift card suddenly becomes valuable. Currencies work the same way. A strong currency usually comes from a strong, productive economy. An economy that creates goods and services other countries want to buy. Cars, electronics, oil, software, medicine, machinery. When other countries want these things, they need that country's currency to pay for them. This demand pushes the currency's value higher. On the other hand, if a country imports far more than it exports, the opposite happens. Its currency is constantly being exchanged for foreign money. Over time, that currency weakens. But production alone isn't the full story. Trust plays an even bigger role. Because money is a promise, trust is everything. People trust currencies from countries with stable governments, predictable laws, independent institutions, reliable financial systems. When investors, businesses, and even ordinary people trust a currency, they are more willing to hold it, save it, and trade with it. When trust is low, people rush to get rid of the currency as quickly as possible. They convert it into something else. Foreign money, assets, real goods. And when too many people want to leave a currency at the same time, its value falls. This is why two countries with similar populations can have wildly different currency values. One might have stability, trust, and consistent production. The other might struggle with uncertainty, corruption, or weak institutions. Over time, the gap becomes visible in prices, wages, and everyday life. And this is where exchange rates come in. Exchange rates are simply comparisons. They show how much of one currency is needed to equal another. They move constantly because economies are always changing. Trade flows shift. Investor confidence changes. Political decisions ripple through markets. When you travel and suddenly feel rich or poor, you're experiencing the result of years of economic behavior compressed into a single number. But here's the most important thing to understand. A weak currency does not mean people are lazy, and a strong currency does not mean people work harder. It means the system behind the money is treated differently by the world. Now that we understand that money is a promise backed by an economy and trust, the next question becomes obvious. What actually makes a currency rise or fall? Why do some currencies feel stable for decades, while others constantly lose value? The answer lies in a few powerful forces working together. The first is trade. Countries don't exist in isolation. They buy from the world and sell to the world. When a country sells more than it buys, it earns foreign money. When it buys more than it sells, it spends foreign money. If a country exports a lot, meaning other countries want its products, demand for its currency increases. Foreign buyers need that currency to pay local businesses. This steady demand supports the currency's value. But when a country relies heavily on imports, the opposite happens. Its currency is constantly exchanged for foreign currencies. Over time, this creates pressure that weakens it. This is why countries that produce advanced goods, technology, or essential resources often have stronger currencies. They sell things the world cannot easily replace. The second force is interest rates. Interest rates are the reward for saving or lending money. When a country offers higher interest rates, it becomes more attractive to investors. Think of it like this. If you had to choose where to park your savings, you'd likely prefer the place that pays you more for holding your money, as long as it feels safe. When interest rates rise, foreign investors move their money into that country. To do that, they need the local currency. This increased demand pushes the currency up. When interest rates fall, money often flows out, and the currency weakens. This is why central banks are so powerful. A single decision can move currencies around the world in seconds. But interest rates come with a trade-off. Raising them too high can slow down the economy. Lowering them too much can weaken the currency and fuel inflation. So central banks are constantly walking a tightrope. The third force is inflation. Inflation quietly erodes the value of money. When prices rise quickly, money buys less. And when money buys less, people trust it less. If inflation is high in one country and low in another, their currencies won't be treated the same. Over time, the currency with higher inflation usually weakens. Not overnight, but steadily. This is why countries with stable prices tend to have more stable currencies. The fourth force is confidence and expectations. Currencies don't just react to what is happening now. They react to what people think will happen next. If investors believe a country's economy will grow, they move in early. If they fear trouble ahead, they move out early. Sometimes nothing has actually gone wrong yet, but the currency still falls. Because markets move on anticipation, not confirmation. This is why political instability, sudden policy changes, or unclear leadership can damage a currency even before real economic damage appears. Money hates uncertainty. The fifth force is debt. Most countries borrow money. That alone isn't a problem. The problem is whether the country can manage its debt. If lenders believe a country can repay what it owes, trust remains intact. If they start to doubt repayment, confidence drops. When confidence drops, the currency suffers. This is why rich countries can carry massive debts without immediate collapse, while poorer countries struggle with much smaller amounts. It's not just about how much you owe. It's about whether the world believes you can handle it. Now here is something most people don't realize. A strong currency is not always a good thing. If a currency becomes too strong, exports become expensive. Local businesses struggle to compete globally. Jobs can be lost. So sometimes, governments actually prefer a slightly weaker currency. They don't say it out loud, but policies often reflect it. On the flip side, a constantly weakening currency hurts ordinary people the most. Savings lose value. Imported goods become expensive. Life slowly becomes harder. This is why currency strength is not just an abstract concept. It directly affects daily life. Your rent, your groceries, your ability to travel, your future plans. Currencies are not just numbers on a screen. They are reflections of choices made over many years by governments, institutions, and entire societies. By now, one thing should be clear. Currencies are not strong or weak by accident. They are shaped over time by production, trust, stability, policy decisions, and how the rest of the world responds to those choices. But there's still a question many people quietly wonder about. Why do some currencies seem almost untouchable? Why does the US dollar, for example, remain powerful even when America has huge debts? Why does bad news shake some currencies instantly, while others barely move? The answer lies in global dependence. Some currencies are not just national currencies. They are global tools. The US dollar is the clearest example. Many international trades are priced in dollars. Oil is traded in dollars. Large debts between countries are often settled in dollars. Central banks around the world hold dollars as reserves. This creates constant demand. Even when the US economy struggles, the world still needs dollars to function. That demand acts like a cushion. So while confidence may wobble, the currency doesn't collapse easily. This doesn't mean the dollar is perfect or immune. It means it is deeply embedded in the global system. Other major currencies benefit from similar effects, though to a lesser degree. The more a currency is used beyond its borders, the harder it is to replace. Now compare that to smaller or developing economies. Their currencies are mostly used internally. They depend heavily on imports. They rely on foreign capital. When trust weakens, there is no global safety net waiting to catch them. This is why currency strength is not just about effort or intelligence. It's about position in the global system. And this brings us to an uncomfortable but important truth. Hard work alone does not protect a currency. People can work long hours. Businesses can operate honestly. Yet the currency can still lose value if the system around it is fragile. This is why two people, equally skilled and equally hardworking, can experience completely different financial realities depending on where they live. And this is also why understanding currencies matters, even if you're not into finance. Because currency strength quietly shapes your life. It affects how far your salary goes. It affects what you can afford to buy. It affects whether saving feels rewarding or pointless. It affects whether traveling feels exciting or impossible. Most people only notice currencies when something goes wrong, when prices jump, when exchange rates spike, when savings suddenly feel smaller. But by then, the story has already been written. The value of a currency is the result of years of decisions piling on top of each other. This is why comparing currencies is not about asking which country is better. It's about asking which systems create trust, stability, and long-term confidence. And once you see money this way, something changes. You stop blaming yourself for things that are systemic. You start asking better questions. You become more aware of how global forces shape personal outcomes. That awareness doesn't magically make you rich, but it does make you informed. And in a world built on systems most people don't understand, being informed is powerful. So the next time you hear that one currency is strong and another is weak, remember this. It's not the paper. It's not the number. It's the story the world believes about the system behind it. And those stories shape everything from prices to opportunities. If you found this explanation helpful, consider subscribing. This channel is about breaking down complex ideas, money, systems, and everyday economics in a way that actually makes sense. And if you want to go deeper, like the video and share it with someone who's ever wondered why their money feels different in different places. Because once you understand how money really works, you stop seeing prices and start seeing the system behind them.